Well, there's been a growing trend of increasing interest rates among central banks. This trend change reflects a shift in strategy away from continuous monetary stimulus and the insurance they used to have for financial markets. So joining us for more on that is Head of Asset Allocation at Alexander Forbes Investments. That's Rob Price. Rob, thanks so much for your time today. So how important was this monetary stimulus for financial markets since the crash in 2008, the crisis?
Well, incredibly important. We've seen unprecedented levels of monetary stimulus from global central banks. I think it's important to, make that point. It's global central banks. South Africa also influenced, but much more of a global theme. The Federal Reserve, the ECB, and in Europe and Japan and so on, stimulating economic activity with very low levels of interest rates and quantitative easing. And of course, the intention was to stimulate economic activity, but a much bigger recipient of the stimulus than the real economy has been the financial markets. And we know there's been this divergence between the real economy and the financial markets, where financial markets have been, getting all sorts of really strong performance for many years, despite the fact that the real economy has been quite weak.
Yeah, and let's talk a little bit about that, the implications of that divergence between the financial economy and the real economy.
Yeah, well, it's a really important factor on a number of different facets, and in one respect, it of course has huge implications from an investment perspective, and that's really my speciality. But also from a real economy, a real person perspective, we need to be aware that divergence is somewhat a cause of the inequality that's going on globally. When you boost asset prices relative to the real economy, then the people who hold those assets do relatively well. Yeah. Now, that's not necessarily some sort of sinister attempt to create inequality, but it's a very unfortunate and strong unintended consequence. And I think that the global economy is dealing with that now without sometimes really understanding the underlying driver of it. And voters can vent their frustration in all sorts of ways that we might not understand, and they might not even understand, but might be related to these kind of very subtle underlying economic conditions.
And I think it's important to also look at the asset allocation that encouraged what the money was chasing yield, wasn't it?
Of course. You said when you lower interest rates, you lower the discount rate. The future suddenly looks a lot more kind of attractive. And so people, take out higher levels of risk. For instance, when Treasury yields, the U.S. bond yields are lowered substantially, then, savers, pensioners can't get the return that they're looking for in their markets. They look for other markets, and you go down the risk spectrum, as I like to call it, into increasingly risky assets. And so all of those assets start to become affected, including South Africa. Okay. And so the implications here, I said, they're sometimes very underappreciated, but the financial markets are very connected, and investors, they keep on looking for more and more opportunities wherever they can find them.
All right, let's look at where we are now. We've got the United States increasing interest rates, and the new Fed chief telling us that there's going to be more to come this year as well. The ECB also indicating that it's pulling back on the liquidity. What does that then mean for the future?
Yeah, I mean, I'm simplifying here, but it's to some degree a reversal of what we've seen previously. If the stimulus has been driving certain, macroeconomic conditions and financial conditions, then we're going to see a change in those conditions. At a very minimum, they're not going to be exactly the same. So we're expecting higher levels of volatility as the stimulus does start to get withdrawn and higher interest rates start to impact the financial markets. We should expect higher levels of volatility. And so, when investors start to react to the news that they're seeing in the media, I think they see it through a slightly different lens. I think you can even start to see things like the whole trade war through this lens, and even the news about Facebook through this lens. And I'm simplifying, but when economic conditions are great and interest rates are very low and valuations aren't expensive on financial markets, then investors aren't too concerned about bad news. Yeah. But when valuations are a bit more expensive and the interest rate trajectory is moving in the other direction, then they start to ask slightly more difficult questions of those assets. And everything just becomes a little bit more judicious. And as I said, when then sometimes the reactions almost get blown a little bit out of proportion, because the conditions are different. And I think that's kind of the period that we're going into now. And so it's incredibly important from an asset allocation perspective, not to say that the world's blowing up or that the financial markets are just going to crash from one day to the next, but it's to appreciate that from an asset allocation perspective that we're looking towards different asset classes to take advantage of this volatility rather than just expecting the conditions like they have been for the last 5 years of very low volatility.
Okay, and I suppose when people are switching out of some assets into others, a little bit of volatility is to be expected.
Of course, I mean there's volatility in the change. So we will be looking for asset classes, as I said, that can take advantage of these type of changes. Things like hedge funds that can take advantage of volatility and longer term investments that aren't so negatively impacted by the volatility and on day-to-day basis as some of your listed equities might be.
We'll leave it there. Thanks for your time. Today, Head of Asset Allocation at Alexander Forbes Investments.